Just a quick disclaimer, anything mentioned in this video is how I invest my own portfolio and it's not a recommendation. Always do your own research or consult a qualified professional before making investment decisions. For those of you that watch regularly, it will probably not surprise you that I tend to favour a passive global equity index fund approach for my personal investing journey as well. This strategy is both extremely simple and very difficult to beat. The popular book on UK passive investing by Lars Coyer called Investing Demystified explains that markets are efficient and that most people cannot outperform the market or pick a fund manager to outperform the market for them after fees and expenses. Therefore, they would be better off by becoming a rational investor and adopting a rational portfolio. The rational portfolio consists of two asset classes, an extremely low risk asset like cash or government bonds, and a low cost World Equity Market Index Tracker. The Global Equity Market Index Tracker is a product that allows you to own global equities based on their market value at an extremely low cost. I'm going to talk through how I chose my own global tracker. I invest through the Vanguard UK platform, and so my choices were limited to a handful of funds when it comes to global equities. There are a lot of other funds and platforms available, and the two guys at monevator.com do a great job of collating the best platforms and cheapest index funds on their blog, so I've linked to their site below. Be sure to check this out. So the four funds I narrowed it down to were as follows: Life Strategy 100% Equity Fund, FTSE All World UCITS ETF, FTSE Developed World UCITS ETF, and the FTSE Global All Cap Index Fund. Two of these funds are exchange traded funds or ETFs, and the other two are open-ended funds. Some platform fees can vary depending on which option you choose, so this is worth checking. However, this wasn't an issue for me as Vanguard's fees are the same for either option. The Vanguard platform doesn't charge a trading fee as long as you use the bulk dealing service and not live trading in real time. This will suit most passive investors' needs like myself. The Life Strategy 100% Equity Fund has a home bias, which means it overweights its UK exposure. It currently has around 25% invested in the UK, whereas the UK only accounts for around 5% of total global market value. Seeing as I am already heavily invested in the UK by the fact that I live here, work here, and me and my partner own a few properties here, I'd rather diversify away from the UK and diversify my non-portfolio assets where possible. Therefore, I excluded the Life Strategy 100% Equity Fund on this basis. The breakdown of the remaining three funds was as follows. First up is the FTSE All World UCITS ETF. This tracks the performance of the FTSE All World Index and is comprised of large and mid-sized company stocks in developing and emerging markets. This benchmark has returned around 145% over the last 10 years, but remember, past performance is not a reliable indicator of future results. This fund contains around 3,462 stocks and has an ongoing charge of 0.22%. The next fund is the FTSE Developed World UCITS ETF, and this invests in the FTSE Developed Index, comprised of large and mid-sized company stocks in developed markets. The FTSE Developed Index has returned around 161% over the last 10 years. It contains around 2,191 stocks and has an ongoing charge of 0.12%. The last fund is the FTSE Global All Cap Index Fund. This is the closest to a genuine global equity fund that Vanguard offer, as it includes large, mid and small-sized company shares in both developed and emerging markets. This is the most diversified option, containing around 6,880 stocks, and this benchmark has returned around 191% over the last 10 years, but at the highest cost with an ongoing charge of around 0.23%. As you can see when we look at the underlying top 10 holdings, that all three funds are very similar. I like to keep things as simple as possible, and the reality is, all of these funds are highly correlated, so I decided to focus on what I can actually control and what research has shown to be a strong indicator of successful investing performance, which is choosing the lowest cost option. I also feel more comfortable investing in developed markets and larger blue chip companies due to the stronger legal systems and accounting standards that these countries possess. Therefore, rational or not, I'm not that interested in investing in emerging markets and small caps. I used to invest in the FTSE Global All Cap Index Fund, which is probably the truest global tracker out of the three, as it includes emerging markets and small caps, but the charge was a little too high for my liking, so I've recently switched out to the FTSE Developed World UCITS ETF, and I am confident that I will stay invested in this fund for the foreseeable future. The most important driver for achieving FI and getting the snowball rolling, especially at the beginning of the journey, is your savings rate. If you can increase your income or cut expenses to invest more money, this will make a far bigger difference in the long run than obsessing over an extra few percentage points of return. The beauty of the one tracker strategy is its simplicity and the prevention of the irrational human brain getting in the way of rational decision making. Pick a sensible, suitable strategy and stay the course.